This chart tracks global steel prices over the last 3 decades. You'll notice a distinct rhythm. Every 4 to 5 years, prices move from peak to trough. Right now, in early 2026, data shows we are sitting exactly at the bottom of a historical trough. Based on these historical averages, the move seems obvious. But 2026 contains a new structural variable that these past cycles didn't have to account for. That variable is capacity. By 2027, the global market is projected to add 165 million tons of new steel capacity. Adding that much supply while demand remains modest drives global capacity utilization down to roughly 70%. It creates an unabsorbable global surplus. Because extreme overcapacity has effectively overwritten the standard laws of supply and demand, relying on traditional cyclical timing is no longer a viable strategy for this market. The epicenter of this surplus is China, where massive industrial output is colliding with crashing domestic consumption. The ongoing downturn and liquidity crisis in the Chinese real estate sector has pulled the floor out from under the country's baseline demand for ferrous metals. To manage this excess, Chinese producers are pushing output into markets that lack trade defenses, aggressively lowering international benchmark prices in the process. For unprotected international mills, the physical consequence of this flood is a complete loss of competitiveness. They are forced to close because they cannot match the price of these cheap exports. A single, unified global steel price no longer exists. The market has splintered into regional zones where pricing is determined more by a country's trade regulations than by global demand. While the East struggles with oversupply, Western governments have effectively severed their domestic markets from global pricing trends by building insurmountable regulatory walls. In the United States, that wall is built on 50% Section 232 tariffs, which strictly limit the volume of foreign steel entering the country. These specific tariffs allow American steel producers to maintain margins that are entirely detached from the depressed prices seen in Asia. The European Union has implemented its own version through the Carbon Border Adjustment Mechanism, or CBAM, which began its definitive enforcement phase this year. CBAM calculates the emissions footprint of imported steel, adding a financial penalty so high-emission imports aren't cheaper than local production. Furthermore, new July safeguard measures cut tariff-free import quotas in half, down to 18 million tons. These tariffs and carbon taxes create artificial economic moats, insulating Western producers from the oversupply crisis hitting the rest of the world. While the steel industry relies on these defensive regulations to stay profitable, the non-ferrous sector is growing based on a completely different set of drivers. Global demand for non-ferrous metals like copper and aluminum is rapidly accelerating, fueled by massive new capital expenditure and investment in advanced, high-tech infrastructure. These metals are essential for the green energy transition and, increasingly, for the massive power requirements of AI data centers. This creates a fundamental split in the metals market. Legacy steel relies on struggling real estate, while copper is linked to the expansion of global computing power. Non-ferrous metals offer organic growth potential that is independent of the trade wars and carbon taxes currently keeping the steel market afloat. For investors, the timing of this shift is critical. There is a significant disconnect between the expectations of 2026 and the regulatory reality of 2027. Look at the European timeline. Throughout 2026, companies track carbon liabilities, but the vertical step in costs hits in 2027 when first payments are due. This jump happens just as free emissions allowances are cut to 5%. In this environment, generic global commodity plays are a liability. Capital needs to be deployed with geographic and sector precision. The 2026 metals market is no longer a single global cycle. It is a map of localized, protected profit zones and high-tech demand hubs. Subscribe for more data-driven insights into the changing global economy.